All right, there we go. All right, it is October 28th. This is the WealthVest Bull&Bear podcast. Drew Dawkin and I are very pleased to be joined by Joel Holsinger. Joel is he is a partner, PM, and co-head of alternative credit at Ares Management. I could the resume, not the resume, but the title goes on for 3 or 4 more lines with all the committees that Joel's on. But I will skip to the end of all of those titles. He's also co-chair of the Charitable Foundation, which I know he cares a lot about, and we're going to get to here at the end of this conversation. So thank you for being with us, Joel.
Oh, thank you for having me.
So why don't we start very much at the beginning? We are going to refer to this space as the asset-backed finance space. And could you just talk about what you do at Ares, your presence, Ares' presence in that space? And we'll do just a little bit of 101 here to get started.
Yeah, it's interesting. If you look at this space, there's been a lot of headlines, a lot of press over the last 5 years or so around asset-based finance. The interesting fact, though, is that I started at Citi, we're going on 28 years ago. It'll be 29 years next year. And if you look at the work and the investments that I was making from a Citi-based bank standpoint, exact same type of investment we do today. It's just that they weren't done inside the banks. They're getting done, obviously, inside of a fund structures. And so when we think of asset-based finance, at its simplest definition, it's really everything's a portfolio. If you think of what you do in private equity, if you think about what you do in direct lending, they're single names, they're single corporate and underlying, and you're very EBITDA focused. Everything we do is portfolios and you're asset focused. And when we talk about these portfolios, there's a couple common things we're always looking for. One, the underlying portfolios are portfolios of loans, leases, receivables, royalties, other fees, but they're all contractual cash flows. What we don't do in asset-based finance, we actually do in our Ares commercial finance group, is more traditional asset-based lending, which is against commercial receivables and inventory. And what we don't do is things like land. We want contractual cash flows. And in the end, we jokingly say you touch our assets every day, because the reality is if you say, where are those contractual cash flows coming from? They come from a consumer. They come from a business. By definition, every one of those tracks back to some consumer or some business that's kind of paying those contractual cash flows. And so really, when we look at what we do, we invest across those broad range of assets. The liquid side of our market, which is insurance driven in a big way, is the asset-backed securitization market. And we do it both through the asset-backed securitization as well as we do private IG or directly sourced transactions. And then outside of the insurance side, what we call our Pathfinder family of funds, we invest in those very similar to what you would see in direct lending or in opportunistic credit, across different pools.
Okay. And just before, I want to get into a little bit of the macro of what are the things that you're looking for? What do you like? Where do you find value? Where do you not find value? Just give us a little bit of that origin story. As you said, you started at Citi. You're doing pretty much the same kind of analysis that you're doing now. Just tell us how that evolved kind of post-GFC or even pre-GFC.
Yeah, it's different than direct lending. I think you could make the same analogy I made up front, which is if you think of direct lending, people have been doing this for 25 or 30 years. They were doing the same assets inside of banks too. And then it was pushed out post-GFC. It's similar, but different. It's similar from the standpoint of all of these assets were done, but they were very consolidated. It wasn't a large group of banks playing across these asset classes. If you really look across asset-based finance, it does take large teams. It does take large infrastructure. It does take large pools of capital to beat. And so it was consolidated pre-GFC. It was consolidated with the banks, but it wasn't the commercial side of the bank. It was the props desk side of the banks. So you had the Goldmans, the RBCs, the Deutsche Banks, Citis, and others that were big players across that, Credit Suisse even. And then the other big player were backed by really commercial finance, if you look at the, not commercial finance, but the other part of the group were done by the standpoint of really looking at short-term deposits and short-term liabilities. And so if you think of capital source, if you think of CIT, if you think of GE Capital, they really lost access to that capital coming out of the GFC and the commercial paper market. And that commercial paper market effectively, when that pulled back, that shut down their liability, which is worth noting. We wrote a great newsletter in our newsletter In the Gaps 4 years ago, one of my favorite ones we ever wrote. And it's a reference back to the 92 election with Bill Clinton. So Drew, I might be missing you on this one, which is
this was around, just not very political.
You weren't voting. You weren't voting in the night. I was voting. So if you look at it, it's liability stupid was the name of it. Bill Clinton had a famous saying of it's the economy stupid. In the end, and it's not just true in asset-based finance, it's true on all investing. One of our lessons learned, and we post these publicly in our top 15, is money makes the world go round. Credit makes money go round. Every asset in the world is valued off of credit. So when you looked at that period pre-GFC, you had cheap capital driven by cheap liabilities because it was done by banks and it was done by commercial paper. Then when the access left for the commercial paper, they slowly unwound. If you remember, Capital Source turned into a bank. CIT actually went through a bankruptcy and sold off assets, and the other parts of it turned into a bank. And then GE effectively unwound, sold off assets, sold off businesses, sold off other things. It was really not until 2011 that the banks started to get pushed out. And as the regulatory capital, Dodd-Frank as well as other things, led to the push out. But the difference is that happened and instantly the direct lending market was created. In asset-based finance, what happened was those consolidated players, those of us who've been doing this for 20 years or more, it really became very fragmented. And the fragmented was, for investors who have looked at niche funds like litigation finance or consumer or aviation or shipping or other things, a lot of that got dispersed across that. And so a lot of that were teams within GE, teams within CIT, teams within some of the prop desks that raised their own capital and did that. But there wasn't big consolidated capital. And so if you look at it from an Ares standpoint, alternative credit or asset-based finance, our predecessor firm was acquired in 2011. It was started in 2007. And that was really the beginning of asset-based finance at Ares. So it'll be 15 years next year. And so because of that, we have what we believe is one of the longest track records and one of the largest track records across that. And if you look at it, there's really only a couple other players that have similar length track records, but generally those are been very focused towards, say, transportation or consumer or other things. What you've seen in the last 5 years, and I remember, very distinctly, I said at a conference once about 5 years ago, there won't be one winner in asset-based finance. There won't be 10 winners. Obviously, direct lending's got a large group of players. Even though there's some large consolidated players like Ares that take a big piece of the share. In asset-based finance, there'll be 4 or 5 because you do have to sit on a big platform. You do have to have all 3 pools of capital. You have to have the insurance-related capital. You have to kind of have right down the middle, and you have to have the opportunistic pools of capital. And so we've seen that really transform over the last 5 years. We believe we're the largest pool of capital on the non-insurance side, if you think about our Pathfinder family of funds and others. But you've seen big growth, but everybody's grown in different ways. If you look at the large players, what you've seen is you've seen some that have owned and gone, almost all of their capital is on the insurance side, and they've focused their capital all towards that. And they've gotten to very, very big scale on the insurance. And some of our peers, others have done joint ventures with insurance companies where they've made strategic investments into insurance companies and they manage capital for them. Ares, we've tried to take a very balanced approach. We want balance on all 3 pools of capital, but we also want balance from the standpoint of we want to make sure we've scaled it to the opportunity set. We want to make sure we have the right size of capital growing into it so that you can source the assets and you can get the yields you need to drive what you do on the insurance, as well as drive what you do on the opportunistic, as well as drive in the middle some of our other pools of capital.
Right. So you don't really feel like you're competing with, you're one of those big 4 or 5 players. you hear concerns and anytime there's any kind of a disruption in markets nowadays, there's going to be a 1 or 2 day freak out. But that there is, there's some credit quality issues recently in sort of in the private credit market. But it seems to me a lot of that is in that kind of middle market space, and in a space where maybe the competition is far, far greater than what you're dealing with.
Well, it's interesting. You could actually say there's two parts of that market to your question, Tim, which is like on one side, what do we don't compete with some of the smaller players, because if you look at it, whether we're doing assets across the insurance side or the non-insurance side, we generally are scaled. We are generally looking at larger opportunities. We're looking at larger investments. And what you'll see is that it gets really thin really quick. If you go away from the insurance market, $50 million is where we start. By $100 million, a lot of players have bowed out, right? They just don't have the size of checks. They're raising small funds and across that. But even within the insurance capital, we're generally starting to say $100 million check to go get it rated to fit within what we're doing for insurance. And we can go up to $1 billion of capital. But that's our even smaller group. You get to 5 or 6 players that really have large origination that can do, especially the $200 to $500 million type of deals that are there. On the other side, so one, we don't play as much on the small size. There's a reason we start where we start. It's not because we're large that we started those sizes. There's less risk. A lot of the risk you deal with is on those startup type companies. A lot of the risk you deal with is, say, a fintech that's actually losing money and really hasn't got to scale. And some people will play in those and own equity or do others. That's more of an equity or a quasi hybrid versus just a straight credit. If you think of the beauty of what we do in asset-based finance, everything's a portfolio, everything's contractual cash flows. And if you look at that, that really leads through. Why do people love the asset class? It's the loss rates, right? You end up having these amazing loss rates over time because even when you're wrong, you get great recovery because we're always looking for one thing that's very different than everything else in your portfolio, which is we're always looking for front-loaded cash flows. We like those cash flows that de-risk us because everything is a portfolio. So we're getting principal and interest payments, not just interest payments and then principal. Whereas if you think of private equity, infra equity, and even sometimes across lending, most of your capital is coming at terminal value. A lot of it's coming at the end. So you're more dependent on the V, which means rates and inflation have a bigger impact on the V than you do. So we have great downside protection that's kind of that's driven by those underlying pieces. But now you go to the small side. What's the problem with running off, even if you have front-loaded cash flows, what's the problem with, if I want to run off a $400 million portfolio, I got a whole bunch of people I can talk to and I can work with on servicing and we can run off those assets. And there's a lot of economies of scale. If I have a $50 million that turns into a $15 million portfolio, nobody really wants to do it. It's not worth it. It's a headache risk. And that's where you have higher severities. Often is that lower end of the market where you play. But so go ahead, Tim.
No, I just, I want to get to where you find value in those big asset, those portfolios that you invest in, but just to kind of address sort of the headlines of the day and not to overstate it. Do you think that there is too much capital, too much credit chasing too little in good credit in that middle market, in those middle market players?
Look, I think if you look through the numbers and you look at the underlying performance of large players, the answer is no. I'd say, are there a lot of tourists in the space? Yes. You definitely have some tourists that have pivoted from other parts of the asset class and pivoted into things. And you have some smaller entrants and smaller players that aren't going to be able to get to scale. What's interesting is two things. One, most of the headlines with regards to, if you look at some of the things that have been brought up, most of the losses on those headlines are going to come from banks. And that most of it is, and the same people that are pointing fingers towards the private credit market are the same people that have exposure in their existing portfolio. and so
we're not going to name names, but I think I have to read through that.
I'm not naming names if you're not naming names, but but it's interesting, which is 95% of the losses that are going to get taken across some of the bigger headline names that have occurred. It's going to be banks that actually take it. And there is a very big difference. As much as we partner with banks and there's things we do, the thing that you have to remember is that what we're never doing is doing a loan thinking about the fees we're going to make on banking or other things.
Right.
In a bank, you're making a loan and you're doing those loans to warehouse to get to a securitization, to make fees, to get to an IPO, to get to a sale. So there's sometimes a little bit of this conflict that occurs with regards to the investment you're making on the loan side versus what you're making on the other side. So on one side, we all want our banks to be boring. We want them to do very safe, very good things because they are borrowing short and they're lending long. And clearly the box they have is to do relatively safe type of underlying investments. But where they make their money often with the big players is the fees. They make it on the investment banking, they make it on the other pieces. And that all works until you take a loss. But remember, banks are 15 to 20 times leveraged. So those losses hurt more. If you think of private credit, even in direct lending, a levered fund is 1-to-1. Most funds are unlevered. They have no leverage against them. So on one side, you've got banks, that are sitting there 15 to 20 times leverage. On the other side, you got private credit that are no leverage to 1-to-1. So the risk always sits with banks because if you think of the unwind of that, they don't match on their funding on an asset liability match, right? They're borrowing short and they're lending long, and they have that excess leverage. And generally, when you think of LTCM, when you think of, the GFC, when you think of COVID, what breaks is not the illiquid asset. What breaks is actually the liquid asset. It generally is tied to banks. And when you see contagion occur and you start to see that run and you start to see that pullback, it's normally kind of driven by that because it's 15 to 20 times leveraged, right? When you lose, think of it this way. If you lost $10 billion on some of the recent headlines in losses, and that all went into banks' balance sheets, you didn't lose $10 million. You lost $150 to $200 billion of capacity in the market. It's gone, right? It's
just explain what you mean there. Because of the leverage, when you lose that on your balance sheet, your ability to then create new credit is impaired by that many multiples.
Yeah. I mean, if you think of the simplest with regards to, I said money makes the world go round, credit makes money go round. In the end, the thing that is the air that goes in and out with regards to markets and economies is credit availability, right? And so when all of a sudden you take those losses, it compresses that very quickly because you are not just taking away the loss to the bank, you're actually pulling it back because you are that leverage. You are sitting at that leverage. And so the multiplier effect that does drive economies and it does many good things, but it's worth saying, like, this is the reason regulators want banks to be boring. And it's the reason that when you think of private credit, you think of others, you're not sitting there leveraged on the underlying asset. There is no systematic risk that sits in private credit. Where you end up having it is, it used to be, you go back 50 years ago, there was only one way that you could really ever grow your economy as a sovereign: banks. Like for 10,000 years, that was how you grew an economy as a bank. So you could say insurance a little bit, but really, if you think of insurance, it was relatively small, especially into the early 1900s, and you really started to scale. What happened in the 1970s? Insurance started to grow, but it grew with its favorite cousin, which is the asset-backed securitization market. Securitization started in the 70s. It really got going in the 80s. That totally changed things. So if you fast forward 50 years, which is sadly, how many years I've been on this earth. If you fast forward 50 years and you look at it from when I was born in 1975 to where we are today, there's now multiple pillars. You've got banks, you've got insurance, you've got securitization market, and you got private credit. And ironically, private credit, securitization market, and insurance are generally matched to their liabilities. You buy assets that match your liabilities. The one that isn't matched to your liabilities is banks. You don't need banks as much to grow your economy as a sovereign as you used to in the past.
Right. One of the things that, Joel, you were on a Bloomberg podcast a couple of weeks ago, and you mentioned the fact that in private credit, you can have a lot more extensive due diligence, ask more questions. Covenants can be more structure tailored. I just kind of, it'd be good for our audience to know why that would be, really.
Well, it's really the work you can do. And it really goes to, we talked about the three pools of capital and whether we're sourcing assets, for our insurance subsidiary and our relationship we have with Aspida, whether we're doing it for our other insurance LPs, whether we're doing stuff across the opportunistic, whether we're doing stuff in the middle. what's the common theme across what we do in asset-based finance, but also what we do in direct lending? And if you look at Ares, almost $400 billion of our capital fits into this category. It's sourcing, right? You're able to directly source and directly structure and directly do a transaction. It's all bilateral that you're working with. And so why is that really important? Which is, the analogy I made on the podcast is it's the difference between being a chef and being a food critic. If you're in the liquid markets and all you can do is buy that bond. So in direct lending, it would be fixed income, right? It would be the fixed income or broadly syndicated market. In our world, it'd be the asset-backed securitization. If I could buy that bond versus create that bond and go get it IG rated or do it in a non-IG format, a non-insurance. If I can go do it directly, I can continue to ask questions until the cows come home. I can sit there and continue to do my work, continue to do my diligence. I can ask for anything I want to. I can continue to work on it. And these transactions often are 3 months to 9 months or more, from beginning to end. If you're in the liquid markets and I'm buying a fixed income bond or I'm looking at an individual deal, the deal is launched, the deal is pricing within 1 to 2 weeks, and you got to make your decision. And you can make some comments on it. But for tax structuring and other reasons, there's only so much I can make comments on. Because the second I start to actually make major modifications versus just being a syndicate lender, I end up running into some restrictions with regards to that and what can fit onshore versus offshore. So one, you're sitting there as a food critic. And even if you're a Michelin star food critic, you can eat the meal, you cannot eat the meal, you can talk about the meal, you can complain about the meal, you can rate the meal. That's it. But you're not a chef. You're not sitting there buying your groceries. You're not putting together the menu. You're not doing the whole thing, the beginning to end. And the advantage you have of being able to do that, it's very high. It's why you see very different recovery levels across the liquid market versus illiquid market. You have better documentation. You just do. Because if you think of the dynamic of, Drew, I decide that I'm going to issue a fixed income deal. And I'm going to hire you at Goldman Sachs or others to go do that deal and go send it out. I obviously just want the greatest execution, right? I'm issuing this bond and others. And you go to Tim and you say, I'm going to go sell this to him. And it looks like I'm going to be fine. I'm going to get the book done. You know what I'm not doing? I'm not listening to Tim on any comments he makes on the docs or anything else. And by the third time that Tim is looking at deals and he doesn't get an allocation, he isn't able to fill it, he kind of lowers this. He says, you know what? I actually probably need to just, I'll take it as is. And all of a sudden you see a slipping of standards, right? You see that across the weakness of docs and others. That doesn't happen as much when you're directly sourcing, directly originating, because you're sitting there going one-on-one with them on a bilateral and you're creating the transaction, you're creating the documentation, but also on the diligence, you're doing all that underlying work and the others. But your incentive is 100% on that investment. You have no incentives tied to investment banking fees. You have no incentive tied to other things. You're just sitting there worried. You live and die on your performance of those underlying investments. And you're going to be living with those investments forever. Because in the liquid markets, I can buy it and 2 months later, I'd be like, sell. In the illiquid markets, I own this thing for 5 to 7 years. So you better get right. And you learn that really quick when you've been doing this for a really long time on the illiquid side.
Let me just ask you the one inevitable AI question. You guys are doing a lot of work. You are in the weeds. You are understanding these portfolios. It's complicated stuff. There's tons and tons and tons of individual liabilities in there that you're buying, or I guess they're assets that you're buying. Are you able to do that with fewer analysts than in the past, or does technology and AI just make your analysts better and your analysis better? Or have you not found it made that much of a difference in what you do?
Yeah. And there's two parts of AI. I will touch the second part, which is data centers and the investment and all the rest. We can cover that if you want to later. The first part, the answer is, look, it's actually one of the unique things about what we do in asset-based finance. Everything is a portfolio. So you can have, a portfolio of 50 or 100 investments, but you got millions of underlying lines. And so it is powerful. Now, parts, as you know, of AI are just, machine learning, which we've been doing for years and years and years before we called it AI. So parts of this we've been doing for a very long time. But what I would say, and this goes to the advantage of scale and the advantage of platforms. If you think of the advantage of scale and the advantage of platforms, Not only do you need to have a good reputation as counterparty, not only do you need to be able to sit there with infrastructure, what is the truth of any AI model? You're only as good as the information. And as you think in a closed circuit basis with regards to who has the most information and that ability to mine and ability to look at that and actually solve, the advantage of AI is scale, right? The advantage of AI is the ability to look across that in those large portfolios. And what's really interesting, is when you look at our world, it's the macro story is not always the micro story. You can look at the top and you can say, let's throw the consumer on the table. If you Googled right now, the consumer, you could come up with 9 different articles that have totally different opinions on the health of the consumer in the United States, like literally conflicting articles. And you know what the answer is? They're all right.
Right. Because we talk about this theme a lot.
Yeah. Like it's all the cohorts. It's all the individual pool within the pool, which is, I'll give you one for your consumers. You can read this in the gaps, and it's published on our website, which is, this is just a weird one of those that you go, that makes no logical sense, but that's interesting. It used to be the priority of payments. The people assumed coming out of the GFC, people would prioritize their auto versus their house.
Yeah.
And what we're seeing right now is people are prioritizing their house versus their auto. And you say, well, why? And I think actually the lesson learned is not people prioritize their house or their auto over their house or vice versa. Priority is people are smarter than what you think. And when their assets underwater, they don't prioritize it. When their mortgage is worth more than their house and their loan on their car is worth more than their car, they prioritize one versus the other, right? And they make sure that, hey, that's where they are. But if you dig even deeper, if you want to double click past that, what we highlighted is generally one thing that's true today that was never true before. There's no subprime residential mortgages. Like they're all prime. And if you look at them, they're all prime and they're super prime and they're very high quality and others because of what happened coming out of the GFC, low advance rates and very high.
Are you excluding FHA from that?
Even with FHA, you still don't go into subprime type of consumers and others, right? You still have a floor of generally 680 or so. And so when you look at those mortgages, they're all performing very well and there's issues or there's no real underlying issues and we continue to see good performance. So on one side, you say, well, look, mortgages are performing relatively well because the home buyer is doing well. Well, one thing we noticed when we are double clicking to your AI question is, what if I told you that we've seen an increase in delinquencies for people who own their home but don't have a mortgage versus people who own their home and have a mortgage? This is a weird one. 2 people, one owns their home, has a mortgage. One owns their home, doesn't have a mortgage. One is totally paying like they've always paid and no issues, the person with the mortgage. And I don't mean on the mortgage, I mean on everything else they do.
Yeah.
The other, we're seeing an increase in delinquencies. And you have to think through this and you have to go, well, who is that consumer? And the answer is it's a baby.
It's a baby boomer. It's an older consumer.
It's a baby boomer with
a long time ago. Their car is a depreciating asset. They don't have to get to work.
And they're the ones that, like, if there are fixed income and they've been hurt by inflation because their increases have been less than what the inflation increases have been. So the cool thing on the AI side is you really can drill down into the data and you can drill down into the data, but you have to have it and you can find these individual correlations. So we've actually been relatively conservative on the consumer the last 2 years. And we talked about this in our newsletter because we saw some things, but to be clear, it doesn't mean it's on the no list. It means you have to be careful where you play. Yeah. It's like housing generally. It's all about the neighborhood. You got to go to the right neighborhood.
Yeah. Well, I mean, the whole theme of the K-shaped recovery or the K-shaped economy has never been more true. We have an economy that's growing somewhere in the 2.5% to 3% neighborhood, and yet we appear to be creating no jobs.
Yeah.
And I understand the workforce isn't growing, but there's still no job growth. And every day you see new headlines that the market celebrates that somehow we're early cycle in this economy, and yet we're not creating jobs. AI has got something to do with that. And just this whole concept of the K-shaped consumer, where the high-end consumer that owns assets, that owns a home, owns a 401k is doing quite well. And if you have an apartment and rent is eating you up and car payments are eating you up. Because you've seen that. You've seen both American Express come out and say, look, our credit quality is outstanding. Jamie Dimon come out, our credit quality is outstanding. But then CarMax or America's Car Mart, they're seeing 90-day delinquencies go through the roof.
But it is the one we highlighted 2 years ago is the simplest. If you own your home, you generally are invested in the stock market. If you own your home price appreciation has gone up a lot in the last 5 years. But even more important, what we highlighted in the last one, if you own your home and you've owned it for a while, you didn't get a mortgage in the last 2 years when rates were higher, you're doing better than those who got rates in the last 2 years because people who got mortgages in the last 2 years got 6-7% mortgages. If you're like myself or you probably, we have sub 3% mortgages, you're not going to touch those mortgages because they're sub 3% in a higher rate environment. So it is very K-shaped. It is very bifurcated, but it also goes to one really important thing people should take away, which is, look, we are seeing some slowing. And we are seeing that, which is why, we tell the team every day, kind of assume a recession may happen, not because we think it's going to happen, but we want to know that our loss coverage is 2x or more from a recession type case if it happened tomorrow. We want to know that downside protection is there in everything we do. Because I do think what you'll see as a shakeout longer term is not all private credit is created equal. Not all annuities are created equal. If you think of the advantage, if you are tied into the advantage to source direct assets on the large platforms from an annuity standpoint and do that, that's clearly a big advantage with regards to the extra protection and the sourcing from the downside you get on documentation and others. But also in private credit, where you'll see a shakeout is going to probably be on smaller players and those who don't have that access because they're sitting there and, you're trying to compete with the Dodgers, right? You're not trying to compete. Like it's the closest analogy you could make right now, which is, you can hire whoever you want from a talent standpoint. You have the scale, you have the infrastructure, you have the advantage. And so there is a little bit of a self-fulfilling portion with regards to not just Ares, but across the larger platforms and the advantage it brings from that.
Yeah. You sound like a Braves fan who misses Freddie Freeman.
So though, as much as I'm Atlanta based and I split time Atlanta and New York, I will say I grew up on the West Coast. So I actually am a Dodgers fan. So that's a little bit biased. So I'm a Dodgers and Lakers. I do go for the Falcons because I've lived here 25 years. But yeah, I actually am a Dodgers fan.
Well, I'm a Mets fan.
You watched the game till 1 a.m. last night, or did you call it?
I did call it, sadly. I had a very early wake up call this morning, but I had the privilege years ago to tied to, you mentioned charity at the beginning, tied to something I did on the charity side with Joe Torre to actually throw out the first pitch for Safe at Home about, I guess, 8 years ago. And that's a pretty cool experience when you grew up going to games and going to things to be able to walk on the field and be able to do that. So it's definitely one of those experiences I'll never forget.
Oh, I can imagine. And we get to watch Ohtani tonight, who may be the greatest baseball player of our lives. But let's talk about relative value a little bit. Where you see relative value, you have your absolutely nots, and even there, maybe there's some value in the absolutely not space. But where are the areas where you're maybe more bullish, and where are the areas where you want to be more cautious if we do have an economic, and you seem to believe we will have a consumer slowdown? It's kind of hard to believe we won't.
Yeah, I think that, look, I don't expect a huge crashing moment, but I do think a slowdown has already been happening. GDP will slow down and jobs have slowed down, to your comment earlier, and others. And I think that's sometimes good, right? I think that there's a good reason for that with regards to ability to spread widening and pricing and other things that come out of it. The relative value really has three components to it. One, we talked about a lot, which is size. What we are seeing, our biggest advantage relative value right now in many ways is size. We're seeing that the larger the transaction, the better the risk and the better the pricing, which totally goes counter to the normal markets. But it's very, very true on our ability to do that. And most of those deals we're doing are proprietary or limited process. We're not really competing with many because of size and scale. The other is geography. It's interesting. We invest across Europe, US, as well as like Australia, New Zealand. And interesting is Europe without UK is one of the more interesting areas right now because you have lower rates and a normal curve. And that itself helps. And they're kind of they started behind us on inflation, but they're now ahead of us. They're in the rate cuts. They're in the other portion of it. and they've gone through it. UK is, in worse shape than we are with regards to rates and kind of coming out of it. So we are seeing some interesting opportunities there. Also, it's a less established insurance market, and there's more regulatory restrictions on things. So that there's a reason we call our newsletter in the gaps. It creates some gaps that are there. The last is asset class. We even publish and talk about our nevers at times, as well as there's some things that we prioritize. And like we've been monitoring consumer. It's not that we haven't been doing consumer, but it's generally been 5% or less across what we do in our portfolio. And subprime's been less than 1% across what we do. That's a third of the market in our world, to be clear. If you look at most of our peers and others, that's a third of the market. And it's been because of 2 years we've been competitive or we've been conservative. And if you go in with that mindset, you lose. So even the stuff you like, you're not pricing it as aggressively as some of your peers. We've also been, we've seen a lot of really interesting things in fund finance. So we've been very active in fund finance. And then you mentioned earlier, digital infrastructure, right? It's the opportunity that there's not enough money in this world for the current appetite for digital infrastructure, especially data centers. So we're seeing those at the top of that. The things that are on our bottom or never list are normally risk oriented. It has to do with the downside protection. And then also some just don't fit our profile. There are some things, patent litigation is a great example, where you got to continue to pay the lawyer or else you're going to get a zero. We like things that feed us. My partner, Keith, co-head, he likes to say it's the horse trade. If you don't feed the horse, it dies. We like things that feed us. We don't like to have to feed them. We like investments with front-loaded cash flows that are coming back to us. So that's kind of our relative value today, and can go wherever you want with that.
Well, let's go into digital infrastructure because one of the things that you have to assess is kind of future technology risk, and how do you make those judgments on what is going to be only a bigger and bigger asset class?
Yeah, I think the opportunity is massive across all things digital infrastructure as well as data centers. It's clearly driven by the desire of AI and the growth and kind of this transformational moment. I think that there's things of AI that scare me from the standpoint of, it does feel very .com like, where there's going to be winners and losers that are different than what we imagine. The thing I remind the team of is, Prodigy and AOL and Netscape, right? And Friend Finder and MySpace. The first movers don't generally win. A lot of times the infrastructure gets created by those. And one of the biggest winners coming out of the .com crash was a failed, online news sale, a bookseller that frankly really didn't win until they got to AWS, and cloud, what they did. And that's when they found their giant. So
really large regions like that.
Yeah, look, 80% of the operating income of Amazon today comes from the cloud and AWS, right? That's where their growth is. That's where they make their money, not everything they sell to us. And so when you look at it and you take a step back to your obsolescence risk, what do we love across the firm? And this is an opportunity with our infrastructure partners, our real estate partners. Maybe you imagine this touches everything we do just because of the sheer scale and the crossover. And we partner across the platform. So this is an opportunity for the large players because the checks are not hundreds of millions. They're all billions, right? And some of them are tens of billions. We like the debt. We're a credit. The Ares' DNA is credit. Over close to $400 billion of our capital across, $570 billion is credit. We're known for credit. It's our DNA. Other firms might be known for private equity or distressed private equity or real estate. Credit's what we do. Why do we like the credit? Your counterparty is Mag 7 and other type risk. Where we're being more careful is where it's not Mag 7. Where who's on the other side of it. And a lot of data centers looks a lot like net lease, which is you care about the real estate and the counterparty, but frankly, you care way more about the counterparty, right? You really care about who's on the other side of that. So if you're doing 5-year debt on a 15-year lease and Microsoft's on the other side of that, all day long, that's great credit risk. And there's plenty of places to play and they're all scaled. And I actually think you'll see potentially spreads widen just because of the supply demand. I like to say the only rule of economics that works is supply and demand. It works every time. It's the one thing that balances. I think the equity is where your obsolescence risk is. There's a lot to do on the build to suit equity. You can build these things for 8, 9 caps and flip them at 5 and 6 cap rates. And there's a lot of value and a lot of upside that's kind of available through that. I think the larger question long-term is the takeout value. If these do become multi-$100 billion businesses, who is buying them? Is it a public IPO? Is it done through others? There's also just the question of obsolescence with regards to, is there transformational changes? So I think where we focused, if you look at across areas, is on digital infrastructure, is on the lending side with our infra debt group, as well as other parts of real estate and us. We've done it across the build to suit and what we're trying to do on the development and others. And we think there's a lot of places to play there and scale. And I do think that's going to be 4 or 5 players that can really do that at scale. And that's one of the things that kind of goes to the broader themes we talked about earlier.
Yeah, it is so different than the equity market. Whereas as an equity player, you have to understand what is the long-term return on invested capital of all of this infrastructure spend. And it's very hard to guess. You just have to say, is Microsoft going to be able to continue generating cash flow on a very, very, very strong balance sheet? And that's a very different equation.
Well, we could do the next 45 minutes where you try to explain the equity markets to me, because quite frankly, I look at the equity markets today and I don't get them. I am baffled by the equity markets when I look at them today on the valuations and the growth assumptions and the multiples and other things. I think if there's one area, like everybody's doing all these headlines around different things. If there's one area that everybody should be scared of, it's the public equity markets, like the margin levels of debt that are there, the downside that can occur, especially if you see any bubbles popping on some of your big Mag 7 and other names. Yeah, I think that would have a ripple effect, and frankly, a ripple effect even through the economy. So I think if you're to say number one place I think there's risk in the markets right now, it's actually public equities.
Yeah, we've been talking a lot about the distortion of passive flows into equity markets, high retail participation. And I have a presentation where I have a page of just kind of known unknowns, Donald Rumsfeld's quote. Yeah. And the number one known unknown is, when is valuation going to matter again? There's a friend of mine who's a well-known portfolio manager. He worked for one of the pod shops and had a lot of success. And he says, the only guys I ever had to fire over the last 10 years have been guys who just can't get away from valuation. Yeah. And imagine that. If you're our age, Joel, I'm a little older than you, and you grew up in an era where everybody was a devotee of Benjamin Graham and Warren Buffett, that's how you learned the business. And trying to be a relative value player in equities now is essentially impossible. There's nobody left except for Mr. Buffett himself.
Well, it's becoming a shrinking world, as you know, because it's kind of like banks. You used to have 12,000, now you have 6,000. It's going to go to 3,000, right? Like the number of public companies are shrinking because what's happening, exactly your point, which is all of the flows are going to your big names via index funds and ETFs. And then there's this entire world that's left behind. Yeah. And there's a reason you're seeing take private transactions and others, because frankly, they're forgotten. They've become, there's a great term from an old mentor of mine, Roach Motel. You can get in, you can't get out, right? Like at scale. So nobody touches them. They just sit there. And honestly, until there's a take private transaction, there's nothing to really do. So it's a very weird bifurcated market in public equities when you look at that right now across kind of the valuation range.
Yeah. It's kind of been our contention that, I guess your thoughts is, if there is to be a correction, it's probably going to be a drawdown in equities leading the way, as opposed to vice versa. So that's the first shoe to fall before, we see a recession.
Yeah, I think the things that have not, the unknowns, I'm going to get my Rumsfeld quote wrong there, but my known unknowns or known unknowns. The thing we don't know, I'm going to mess this up. The thing we don't know with regards to AI is power, right? Like power is a 10 and 20 year problem. And there's really only 2 solutions, and one is nuclear and the other is natural gas. Well, the third is fusion, right? Which one do you want to bet on? Yeah. On timing? Yeah. The reality is that natural gas is a 5 and 10 year problem. It would take 5 and 10 years to get turbines going to even slightly dent what we need from a consumer or from a demand standpoint. Yeah. And nuclear is a 10 to 30 year problem from a projects, and fusion's probably a 20 to 50 year problem. And so if you were to say there's a wall we may run into, it might run into, what is the revenue model for AI? right? And how does that do? Because you've seen, and I think there is a revenue model, but we need to discover it pretty quickly from a cash burn standpoint and justifying all the CapEx. And then the other is just this broader question of, okay, what is the power that's going to do this? And I think it's going to lead to the existing data centers having a lot of value, potentially if you get constrained on power. But I think that's the ultimate thing that could slow the future growth rates, right? Where the assumptions on growth could get slowed. And I just finished 2 books, Only the Paranoid Survive and The Intel Trinity. If you want to have a not so warm fuzzy on how you feel about NVIDIA, read about anybody, if you read The Roller Coaster, and I grew up in, Boise, Idaho, I went to high school, Micron Technology was there.
Sure.
You live, DRAM and chips, like there's cycles, and nobody has really proven they can do it for extended time periods. There's very volatile cycles that occur from this.
Yeah.
And it's because you get this big buildup and then all of a sudden a big collapse and oversupply in others. So I think people are pricing perfection right now in some parts of those markets.
Yeah, I mean, as I always say, there's a reason why early cycle Micron could trade for 40 times earnings and why late cycle it could trade for 3 times earnings. But
exactly.
I want to be respectful of your time.
Sure.
And we skipped ahead on your title, and one of them is co-chair of the Charitable Foundation and the Promote Giving that you do at Ares, and that you're actually pushing across the industry. And we were talking about it last night. It is not insignificant numbers. So if you could just talk a little bit about what you're doing there.
Yeah, this is, I'll give you the short version, but the, near and dear to my heart, I'm a poor preacher's kid from Boise, Idaho. You guys are in Bozeman. Yeah, I'm from Boise, Idaho, and born in Eugene and lived with high school in Boise. And, my mom was a nurse, and, to their credit, I was definitely raised to give back. We didn't have, we were on the poorer side, but we were, gave our time. And my dad, to his credit, was doing trips to India and when the wall came down, Ukraine and Russia, and he was going to South Sudan until a few years ago. And so, I think that, about 20 years ago or so, my wife and I agreed that we were going to give almost all of it to charity, and set it up from that way, from day one. And then I'd gotten involved more and more with different charities. And one of my favorites is an organization called Path Global Health, which is tied to a lot of vaccination programs across malaria, polio eradication, tuberculosis, and other programs across the globe, 72 countries. I joined their board, a number of years ago. Fast forward, I did a trip with them, and I came back with this idea of what if we could do something more? And what we came up with for our Pathfinder family of funds, and it was a percentage of 0 when we started, so it's always easier when it's a percentage of 0, is I basically said, hey, look, what if we donated a portion of our promote to charity, to health and education charities? And Ares, amazing, Mike Garrett is our CEO and been a friend for a long time, fully signed on and loved it. That started that program. If you fast forward today, it's almost $18 billion that's under the Pathfinder family of funds. We've already accrued, and it grows every quarter, over $40 million that will go to charity across that. And we really didn't get going till 2000. We launched the fund in 2019, and our final closing was 2021. And so we've kind of grown from there. So it's grown very quickly. It will continue to grow, obviously, with the growth of the returns and the funds. But it's important because none of it's coming out of investors' pockets. It's all coming out of our pocket, and it's coming out of our share. And it only happens if we perform. So it's full alignment from the standpoint of the better we perform, the more money that we give to charity. And so from that standpoint, we've said for a while, what if we got others to do this? That started the foundation, which is the Ares Charitable Foundation, which has now made over $70 million of grants, having nothing to do with what we've done with Pathfinder, above and beyond that, which is from the organization that started in 2021 and is ran by Michelle Armstrong and co-chaired by Mike Garrighetti and myself. So it led to this culture of giving, and how do we continue to do this on this? And we thought that that's something that's missing sometimes. How across Wall Street can we tie performance and giving? How can we tie what we do every day and we love to kind of more of that giving purpose and others across charitable organizations? So we actually launched a couple weeks ago. We've been working on it over a year. The next iteration of this, which is how do we get others to do it? And the program's called Promote Giving. You can look at it on the website, as well as there was an AP article that profiled it, as well as a press release. and other things and on social media. And we got 8 other organizations to agree to sign on to give at least 5% of the promote of their selected funds to charity, whether it be health, education, housing, or other. It includes, Caller and Pantheon and Related and Silver Point and Derby Lane and Ascend, as well as a Macroor. And I apologize to my partners, but I'm missing one, I'm sure. But it's and Pretium on that. So it's some very big players across the industry that we've all come together and said, how can we kind of do something that kind of drives and to promote giving? So it's something we're very proud of. There's over $35 billion of AUM that's pledged to do that across those organizations. And we think we're just getting started. We're hoping to add other organizations to the Promote Giving Pledge, grow it from there to have that kind of just quantifiable. Because what it does is I never imagined it would get this big. Because in the end, if you tie your economic models, Mark Benioff from Salesforce did a 1% of his profits, before he started the company to go to charity. It's over $1 billion just given to charity. He never had any idea it was going to be $1 billion.
Sure.
And so part of it is just tying what you're doing towards that so that it actually drives that and drives both the impact and the charitable giving you're doing. So it's been amazing. It's the reason I will never retire because, as you probably heard through this podcast, I love investing, but it gives me the reason I'm doing it for the rest of my life.
Well, that's extraordinary, the amount of money that you've raised in just a few years. And then you guilt all of your competitors and others in the industry. And
guilt and inspire. We're okay with both. Look, in the end, it comes from LPs. If you guys start saying, hey, look, why haven't you signed on to Promote Giving, whether it's retail investors or institutional, that will change everything. And it's something that I have limited doubts that over time, this could turn into billions of dollars through this pledge if we get the right people signing on and we can grow that. It could be even larger than that if it becomes the industry standard. It is amazing amounts of dollars that kind of can be focused towards it if it's even 1% to 5% of the industry.
Yeah. And maybe someday we won't have to worry about vaccinating kids for polio anymore.
We're close. We're very close. There's only 32 cases last year. We're very, very close to eradication. It's only Afghanistan and Pakistan, actually, which is why we're not there. It's hard to address.
Sure. All right. Listen, Joel, incredibly educational. You were very generous with your time. Thank you so much for doing this.
No problem. Thank you for having us and appreciate everything you guys do.